Hello, everyone. Today on The Final Bar, I'll be talking with Willie Delwiche of High Mount Research. We'll talk about some of the charts for him that tell the story of narrow leadership, certainly starting to change. We talked about the change of character in the market, breadth conditions improving, sentiment spiking higher. Ladies and gentlemen, this is The Final Bar. Hello, everyone. Welcome to today's edition of The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of StockCharts. The StockCharts platform is really designed to empower you as an investor to better understand what's happening around you as an investor. I always talk with people, with clients about their market awareness or their situational awareness. How do you understand what's happening? How do you focus on what's working and what's not? How do you recognize trends that are in place, trends that are changing, inflection points? I would argue technical analysis is an ideal toolkit to stay on top of the movements. It does not always or often answer the why. The why is what fundamental analysis and economic analysis and geopolitical analysis can all help us understand. But the primary goal of an investor is to focus on trends, I would argue, because that's how we're paid. We're not paid based on fundamental valuations. We're not paid based on our ability to predict a geopolitical outcome. We're paid on price. So let's analyze price and see what message we can draw back from price action. When we look at what's happened today, you think about yesterday, Wednesday, sort of this dribble down move, finishing more toward the lows of the day. The S&P today moving back to the upside. So let's go right to the market recap and talk about those movements in detail. Here's sort of that V-shaped experience we have from yesterday's downdraft and today's sort of rally. We finished near the highs of the day, not quite getting above 4,300, but getting very close to that crucial level of resistance. Now, when we look at the major averages, just think about the changes. The S&P up 0.6%. At the close, just below 4,300, around 4,294. The NASDAQ composite outperforming today, up 1%. Some familiar sectors at the top of the list today, with consumer discretionary and technology 1 and 2. When all was said and done, mid caps and small caps, who have been stronger areas of the market here in the last week, giving back some of those recent gains, with the S&P 600 small cap index down 0.6%. Volatility continues to move lower. So we see the VIX pushing below 14 today, down around 13.7. And again, that lower VIX is sort of an unusual feel to this markets if you compare it to the last 12 months. Go back about 2 years ago, it's pretty average, right? So it depends on what we call the volatility regime. It depends on what sort of mode we're in. What we've seen is volatility sort of pushed to the downside. It's interesting, and what one of the things I'll talk about with my guest today, Willie Delwiche, is that relationship between price action and volatility, which should be a lot of fun to kind of go through that. Looking at some other asset classes to see what we can see. Bonds came off yesterday and pushing back to the upside today. The TLT was up about 1.2%. That's looking at bond prices. Yields, of course, then coming down with the 10-year yield down to around 371. Long bond yield around 389. Dollar index down from yesterday as well. At times, we've called the dollar the wrecking ball for risk assets. So my general thought is, risk assets can accelerate to the upside when the dollar starts to weaken up a little bit. Sort of the dynamic we saw today with growth sectors for the most part at the top and utilities, the dollar coming off. Looking at the commodity space, sort of a really strange day looking at the DBC. That's the little preview chart that you see over here, that big drop in the middle of the day. But if we look at commodities in terms of the net change from yesterday's close to today's close, not much difference. The DBC was up about 0.2%, quite an improvement from gold and silver. I'm quite certain that happened because I know on yesterday's show, we highlighted a chart with gold breaking down below the lower trend channel. So of course, the market gods caused gold to to bounce back to the upside today. I think that analysis still holds. We have to see what remains to be seen on whether we get back into that trend channel. But GLD, for what it's worth, up 1.3% today. Silver, much better day, up 3.7%. Crude oil prices coming off a bit. Finally, with cryptocurrencies, certainly a more noisy space than other asset classes, but settling down a little bit today. Yesterday was this big rotation lower. Of course, a lot of regulatory challenges in the cryptocurrency space. I was talking with Julius de Kempner yesterday. Talking about a number of things, but Julius has done a lot of media outreach for StockCharts related to cryptocurrencies. And we were talking about just how the whole, the value proposition, one of them certainly with cryptocurrencies, is a lightly or non-regulated space. That's really core to it, right? It's a decentralized exchange of value. And so all of a sudden when regulatory discussions start happening, when we have, regulators, suing exchanges relative to cryptocurrencies, that's going to put some pressure on prices. That's what happened yesterday with Bitcoin and Ethereum really pushing to the downside. Today, a nice rebound back to the upside, but not a big move. Bitcoin was up about 0.7%, Ether up 0.8%. Finally, looking at the 11 S&P sectors, consumer discretionary number 1, 1.5% higher. Technology number 2, 1.1% higher. After that, it drops down. Consumer staples, interestingly, was third from the top, but overall, these are sort of flat, a little bit up sorts of names. A handful of sectors down a bit, but no real negative movements. The XLRE, which is the real estate ETF, down 0.6%, followed by energy and materials, all in the red. Let us take a look at the S&P daily chart. We'll look at this one and just check in on what today's movement means relative to the overall trend. And I think it continues to come back to 4,300. This pink shaded area on my S&P 500 chart represents 4,300 to 4,325. There's a level we've talked about for quite some time, really since back at the August peak, right? What a clear rally phase into this level around 4,310, we'll call it, and then rotating back lower to make the new low into October of last year. That was the last time we were overbought. We were briefly overbought at the February peak, not quite overbought yet, but we're right back at that point. 43.25 is the intraday high. 43.10 is basically a 61.8% retracement back up from the October 2022 low to the January 2022 all-time high. So 4,300 to 4,325, important range. Do we have enough momentum? Do we have enough leadership from the mega cap stocks to push above there? I think very much a question mark at this point. I would argue the benefit of this sort of speculation is the proof is in the price. The chart will tell you when that level is no longer going to work because the price is going to break above there. For now, the last week has continued to bounce up against 4,300. We have continued to fail to eclipse that level to the upside. Get above 43.25. I think it's a very different discussion very quickly. Now, elsewhere in my Mindful Investor live chart list, I have a series of other charts to sort of hit with you. Advanced decline data looking less negative, right? All of these for me are now color-coded orange. I briefly had the small cap 80 line color-coded red, but we're sort of back above the 50-day moving average. It's hard for me to see that as a negative trend at this point. It's more neutral, and I think that's fair to say. The small cap 80 line really didn't make much of a new low, and now sort of bouncing above the 50-day. They're all above their 50-day moving averages, and they're all below their February highs, which means they're kind of neutral. And if you think about it, it's interesting how the Nasdaq, of course, has blown through its February high. The S&P has now clearly blown above the 4,200 level, but the advanced decline lines using those stocks and then other slices like mid caps and small caps, none of them have gotten above their February high yet. So while we've had some improvement in breadth, we really haven't had some of the follow through that I think would really make it an easy call to decide whether the trend overall is positive and whether we have enough breadth support. Another chart to sort of break down thinking of breadth is looking at the percent of stocks above key moving averages. We have the S&P 500 in the top panel, then we have the percent of stocks above their 200-day, the percent of stocks above their 50-day. Both of these indicators right about at the same level, around 58%, which means in both cases, over half of the S&P members are above those moving averages. Those numbers stay above 50%. Those numbers continue to improve. The breadth conditions are becoming more and more encouraging. As long as we hold that 50% level, I think it's, again, a pretty easy conclusion that the conditions based on that indicator are fairly constructive. In terms of sentiment, we don't talk about the AAII survey as much. We used to talk about it every week, but it sort of depends on how I think of these different indicators. Sometimes indicators become more or less a part of your thought process, and I've gotten away from sentiment because for a while it didn't feel like it was necessarily helping me understand turning points or understand inflections. I felt like I was getting that from other places, but I do keep this on my watch list just to see if there are big sudden moves at any point. I think it's worth noting is on this most recent survey, which basically hit today, sort of Wednesday into Thursday, is when they calculate it. The number of bulls is the highest we've seen since November of last year, just before the all-time high in the S&P. We're around 45%, which means almost half of the respondents are bullish. And that's up from around 25 to 30% just a week ago. Bears are now at the lowest level we've seen since going back here to November as well. We're almost the same level that we were there in the second week in November of last year. It's only 24% bearish. It's almost a 2-to-1 ratio, bulls outnumbering bears, which is a very different environment that we've seen in quite some time. Looks a lot more like late 2020, the first half of 2021 in terms of the conditions we're seeing now. And it's interesting, that was another sort of low volatility rally phase. So you're seeing start to be more and more believers. The spread between bulls and bears clearly favoring bulls. And again, we're now back to sort of that 2021 nice, consistent, steady uptrend type of feel to that indicator as well. The Name Exposure Index surveys a group of money managers and asks them what their positioning is in the equity space. The answer this week is 90% allocation to equities. The last time we were this high was at the end of last year, right at the all-time high in the S&P. Now, it's worth noting back through 2020 and 2021, we often went above there, and a number of times actually went above 100%. I've often found getting above 100% often is a contrarian sell signal. That means investors are way too bullishly positioned, and usually you get at the very least some sort of meaningful drawdown. At worst, or maybe at as more of a severe reaction, you can get more of a significant drawdown. Final thing I'll show you is this consumer discretionary versus consumer staples. This has certainly been favoring offense over defense. The reason why I want to bring up this chart, I just put a video on my own YouTube channel called Market Misbehavior, focusing on this rotation away from defense into offense. The good folks at iShares, I think these are the ones that produce these equal weighted sector ETFs. They changed all the tickers just earlier this week. So if you're confused about that, we're in the process of updating our platform and getting the data pointed to the right places. But if you see, these are the equal weighted consumer discretionary and consumer staples tickers. Both of these cap weighted and equal weighted versions favoring offense over defense. Let's take a quick break. We'll be back with Willie Delwiche of Highmount Research. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We appreciate so much you joining us every weekday after the close for our show. A couple quick announcements before we bring on today's guest, Willie Delwiche. First off, we welcome your questions. We really appreciate you sending us questions that you are running into as you are analyzing the markets using technical analysis. What can we help you understand in terms of technical indicators, technical approaches, market history, market dynamics, whatever it is, we're here for you. Our email is thefinalbar@stockcharts.com. We're on Twitter @finalbarsctv. We are on YouTube. Put a comment below the video you're watching on our Stock Charts YouTube channel. We'd love to hear from you, and we'll hope to answer your question live on the air on Friday's show. Upcoming guests next week on Tuesday, Gina Martin Adams of Bloomberg Intelligence is going to be coming through, helping us mentally prepare for the June Fed meeting going on Tuesday and Wednesday. Wednesday, of course, is Fed Day. We'll have an update on what we're seeing and the technical implications of that. Just connected with Doug Ramsey of the Luthol Group, which will be joining us on Thursday, June 15th. Of next week. So a lot of great guests, as always, coming through and sharing their expertise. Speaking of which, let's get to one of our best guests, Willie Delwiche. Willie's the founder and investment strategist at Highmount Research, coming to us from Milwaukee, Wisconsin. Willie, good to see you. How are you? I am well, Dave. How are you? Doing very, very well. I appreciate you coming on and sharing some thoughts with us. It's been such a fascinating year. We've had, again, a narrow-led market rally, but things sort of starting to change. I think a lot of investors are questioning how this is evolving and whether we continue to see the trends we saw year to date, or if things are starting to shift. I appreciate your help, helping our viewers understand that. Your first chart is looking at the relationship between the movements of the market and the volatility. Talk us through this one and what it represents for you.
Sure. So on the x-axis, we have what we call market strength. It's a percentage of days per quarter that you have more new highs and new lows on the NYSE plus NASDAQ. On the vertical axis, that's what we call market volatility. Here, we're not talking about the VIX. We're talking about percentage of days in a quarter that where the S&P 500 has moved 1% or more. And so what we saw last year was a lot of weakness. So the left axis or the bomb axis was way to the left, lots of volatility, very much towards the top. Coming into this year, first quarter was a little bit of both. We had both strength and both volatility. We had, came in early this year, 30 some odd days with more new highs and new lows. It felt like the first quarter this year we had made this really strong turn in the market. Fast forward now to the second quarter, we're in this really unique position where we have neither strength in the market as measured by new highs versus new lows, nor volatility. And I don't need to tell anyone that we don't have volatility right now, whether we're talking about 1% moves or the VIX or anything like that. So the point here is Q2 2023 is a really historically unique environment that we find ourselves in. Typically, when we have this little strength, we have more volatility, or if we have this little volatility, we tend to have more strength.
Perfect. So we're in uncharted waters, right? Pun intended, which is a fun place to be, I think, for a lot of investors. What do you make of that condition? I mean, I guess a lot of times we think of volatility as the VIX, similar reading, right? You're seeing any volatility measure sort of coming down here. Is that by definition a good or a bad thing for the markets? Is there a way you can generalize that, or is it more descriptive, just talking about the nature of how things are trading?
Well, there's a couple. First, it is descriptive.
Yeah.
But I would say historically in periods where we don't have strength, in order for the market to go up, we need volatility. We need a VIX above, say, 28.5 or so. If you're going to get that fear that pulls people eventually into the market, from a contrarian perspective. If you don't have volatility, you really need that underlying strength if the market's going to do well. We haven't seen that. And so to kind of go back to the VIX, these low readings in the VIX in the absence of more new highs and new lows, for me, that's a pretty troubling level of complacency on the part of investors right now.
Ooh, the complacency indicator. I like that. I like that adjective. Let's go to your second chart, Willie. We're talking about, we've talked often about the relationship between trend and breadth and sort of how that plays out. Here's your chart looking at the S&P and then an AD line. I'd love for you to talk through. What is this chart telling you about the conditions here?
Yeah, so typically the index, that's what you're seeing at the top, in orange, and there's a long-term trend indicator. We've overlaid it. It's a 100-week regression-based trend indicator. That's turned higher. The index is dependent on, however you count it, 7, 8, a handful of mega cap stocks working, and they're working. So the trends in the indexes have generally turned higher. Beneath the surface, here we're going back again from a breadth perspective to new highs versus new lows. We haven't seen that turn yet. And what's interesting is most of the gains, going back, into the early 90s in the S&P 500 have come when this net new high advanced decline line has been moving higher. Right now, it's still moving lower. Good news, we've had 5 days now in a row of more new highs and new lows. So it's getting to the point that's going to start to tick higher. The question is whether or not that can be sustained. If you look closely and you've got a magnifying glass, you can see that in January, this turned higher just briefly. Yep, right there. It didn't last. And really, I think that's the question that a lot of people are asking after, a week or so of this improvement beneath the surface. Can it last, or is this just another short-lived, kind of, call it a rotation, call it relief, whatever? Is it actually going to sustain itself this time versus what we saw in January?
It's been such an interesting year in terms of breadth analysis, right? Because we've seen the market, I was always taught, the market moves higher on stronger breadth. Like that's kind of the classic bull market configuration. We just haven't had that. And now all of a sudden, breadth conditions starting to improve. It feels like just in time for the market to start to stall out here when we get to S&P 4300. How important is it, in your opinion, to see that improvement in breadth, to see further upside from here? Or can we continue, if we just see growth, the AI trade, the mega cap trade works, how far does that continue to go, right? I guess what has to give first, right?
Yeah, historically, yes, you need breadth, but historically, you've had a less top-heavy index, and so
Mm,
there's two sides to the top heaviness of the S&P 500 or the Nasdaq right now. Is yeah, it's out of character with history, and so you would say you need a lot of strength beneath the surface to send those trends higher. But if you've only got a handful of stocks that make up a vast majority of the index, you don't actually need breadth as long as those stocks stay higher. So it's a little bit of an
mm.
index construction question. And it's pretty unprecedented for, I mean, for even guys like us that have been around for a while. It's something we've not seen.
Yeah, right. I was going to say one fascinating thing about what you and I have decided to do professionally. There's always something new to try to figure out, which is, I think, one of the coolest things and one of the most challenging things about this game we're trying to play. Your last chart, Willie, is talking about the Fed. Of course, we have Fed Week next week. The expectations for what the Fed is going to do and the trajectory, I think it has tended to be a fluid debate here, particularly in the last couple of weeks. Talk to us about your understanding of the Fed going into what we're approaching next week.
Sure. So first, I just say the market has been expecting the Fed to pivot for months now, and what we've seen is trying to show on the chart here is the trend. The Fed has been persistent. They've kept hiking. Then now we might get a pause or a skip depending on what sort of nomenclature they decide to put on it. It's the market that has been pivoting from, have they done enough? Do they need to do more? Will they start to cut? Or are they actually serious about this higher for longer? And I think as the market, as yields move higher, that's the market acknowledging that inflation hasn't come down enough for the Fed. And even if they skip a meeting here, they're probably going to signal via their economic projections, their dot plot, that more tightening is more likely than not in the second half of this year. And so it takes away some of those expectations that the Fed's going to pause and then pivot in the second half. We've seen other central banks, Australia, I think Canada, have they paused and stopped for a moment and then they resumed hiking. I think that's probably the path that the Fed is going to be on in the second half of this year.
When you think about that as a potential outcome, which I think is a great way to think about it, Willie, how do you position yourself with that open question next week, and thinking about the breadth conditions and all these? How are you positioned in this sort of environment? Is it just to stick with what's working until it doesn't? Is it to rotate a little more defensively to try to ride this out? How are you sort of approaching this environment?
Yeah, so from a systematic perspective, if we're just following price, our models are long stocks right now, because stocks relative to bonds are making new highs, stocks relative to commodities are trending higher. So just from a systematic trend following perspective, you lean into the equity market strength on an absolute relative basis. If you want to start to add in things like don't fight the Fed, some of those kind of, if you will, exogenous to the market kinds of factors, I think being a little bit more on the sidelines makes a little bit more sense. The market tends to struggle when central banks are raising rates. The market tends to struggle when corporate bond yields are trending higher. Those are still intact. And so I think you're the one, Dave, that I heard it from first. I'd rather be on the ground wishing I was flying than in the air wishing that I was on the ground. So I'm a little bit on the ground. Yeah, it's clear skies for the moment, but I'm just not comfortable leaning into it from a discretionary perspective right now.
It's interesting. I have my chart up of the S&P versus the TLT. So looking at just stocks versus bonds, simple ratio. And as a trend follower, it's pretty clear, right? Over the last 3 to 4 years, it's just been, and even longer, it's just clearly been favoring stocks over bonds. What would it take for this to stop going higher, right? At what point does it seem like an obvious time to sort of take risk off of equities and go into bonds? Is that a particular environment we haven't seen? Or how would you think of this relationship that seemed incredibly persistent now for a while?
Yeah, so I think two things there. And this actually goes back to something you were talking about in your first segment. The first thing is investors believing that yields are going to be high for a while, so that you can move in, that they've kind of moved about as high as they're going to be, but they're not going to keep moving higher. So yeah, so they can rotate into bonds. The other thing is, from a sentiment perspective, if investors who are still overweight equities give up on equities, then you start to see that rotation. But the sentiment data you were mentioning today that's not happening right now. Investors are joining the bullish party. They're at high levels or seemingly high levels, but you remember it takes bulls to have a bull market. So actually seeing this expansion and optimism is a pretty healthy thing at this point if we want to put the bull market label on whatever this market is right now.
It's a really good point. You look back to like 2020, 2021, a lot of those sentiment indicators can go high and remain high for quite some time. Willie, this was such a fun conversation. Thanks for bringing some charts with you, being willing to go wherever we went with the questions. I really appreciate it. Be well there. Stay safe in the upper Midwest. We'll talk to you again soon, all right?
Thanks a lot, Dave. Thanks for having me on today.
That's Willie Delwiche. Willie's an investment strategist and founder at Highmount Research, and I really love his approach. Willie's just a genuinely nice person and just really thoughtful in terms of how he goes about his process. I love thinking about the relationship between stocks and bonds, what the Fed meeting means from a technical perspective, but also some of the macro implications and how to understand and I guess integrate some of that data along with a good technical approach. That was a great little mini masterclass on how to think holistically by Willie Delwiche at Highmount Research. We got to wrap the show, folks, and go to the 3 and 3. 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1. When we talk about breadth conditions, again, I think it's easy to try to label things as bullish and bearish, and I try to avoid that sort of simplistic label, but it's so tempting because it's the easiest way we can just try to gauge where are we at. And if you ask a group of people, are you bullish or bearish, it's a good way to read the room and sort of get a sense of where the sentiment is. But when you're analyzing indicators like advanced decline data, I think you have to take it a little bit more deeply, I guess, or a little one level lower in terms of what the trends mean. For me, looking at the direction of price versus the direction in breadth indicators is super important. One of the big challenges, I think, to the sort of traditional bull market playbook has been a lack of strong breadth indications as the S&P is testing key resistance levels, particularly now versus February. Look at any of these advanced decline lines in February. Look at where they're at now. And you can see, of course, they're nowhere near them. But we're starting to see an improvement. In the last couple weeks, you're seeing all of these AD lines start to rotate higher. Now, a lot of that is all the other stocks, the stocks that are not the FANG stocks, starting to improve a little bit. Sectors like energy and financials and industrials and healthcare and other places where you're starting to see some signs of life. Do we see further improvements? Do we see advanced decline lines actually get above their February high? I think that's an important chart to continue to watch. I think further breadth certainly is not going to be a bearish thing. And so that's something to look at. Chart number 2 is looking at the highs and lows. I loved some of Willie's visualizations, the scatter plot, thinking of the relationship between a breadth indicator and pure volatility, right? Looking at strong moves in the underlying index. Here we're looking at one of my charts looking at high-low data. So this is looking at new 52-week highs and new 52-week lows on the New York Stock Exchange and the S&P 500. Those are the bottom 2 panels. The panel just above those is the net difference every day between new highs and new lows on the New York Stock Exchange. If you look at the last 5 trading days, new highs have outpaced new lows. The last time we had 5 days in a row, it's been a while. You have to go back here to April, which is where we saw some strength coming out of the March low. Going back to January and February, we had more of a bullish sort of cyclical phase, a nice 6-week run back to the upside. Looking at an improvement in new 52-week highs. For the market to break above 4,300, 4,325, you need individual stocks leading the way higher. Now, it's been the mega cap stocks that have done the bulk of the gains that have driven the benchmarks to the upside. Do we see more and more individual stocks making new 52-week highs? I'm starting to see that over the last week. I would need to see a lot more green and a lot less red on this chart consistently to be more and more optimistic. Finally, Adobe, just another great example of the Fibonacci retracement analysis that we can do on StockCharts. If you take the November high for Adobe, take the September low of last year, you will see we are this week right at a 38.2% retracement on $437. That lines up really well with the highs from August and May, June of last year. Can we get above that level, above 440, 450? That would be compelling. It's not happened yet. Folks, that's a wrap for the show. Special thank you to Willie Delwiche of Highmount Research joining us from Milwaukee. Dave Keller at StockCharts.com. Have a great night. We'll see you tomorrow.